is kind of like copying off the smart person next to you during your exam. You don't have to think too much about what you are doing, and you know you will still get decent results. Hi again, everyone. Welcome to the fifth installment of the vlog. I hope everyone is doing really well out there and 2020 has been treating you well. My last video that I produced, which was what to do with $10,000 in 2020, has been the most reacted to video that I've produced to date, particularly in terms of the number of views, but also the discussions I've been having with my peer group around the topics in the video. I'd previously envisioned doing a video on a different topic today, but however, since all the conversations I've been having about the last video, I decided that I'll put that off and dedicate this video to exploring one of the issues raised in the previous video, that being index funds and specifically, what is an index fund? In my last video, which I have linked in the description below, I explored some of the potential returns people could make through investing in index funds, and I mentioned that about a one-off $10,000 investment could grow to over $4 million if left to compound for 49 years based on the historic returns of the Australian Stock Exchange. That being, if you left the $10,000 from the time you turned 18 until you retired at the age of 67. Before I got into investing in stocks, I was hardcore into property investment. It wasn't until I read a finance book by Tony Robbins called Unshakable about 3 years ago that I began to realise the long-term potential of the stock market. Before reading the book, I had previously owned stocks but had sold them for only a small profit as I couldn't see the long-term potential of share investing, and I was weighed down by the negative connotations that people around me often spruiked regarding the volatility and risk of share investing, particularly when you consider that this was in the immediate aftermath of the GFC, so everyone just thought like the stock market was the worst thing ever. I'd always thought that to invest in stocks, you basically picked a company that you thought was going to do well and took a bit of a financial bet on it. I didn't realise that you could bet on the entire market or a large part of the market in the form of an index fund, and I certainly hadn't really comprehended the power of compounded returns over a long period of time. Anyway, enough about me. What is an index fund? At a simple level, an index fund is a form of investment or managed mutual fund that aims to track the performance of some sort of index or market benchmark. An index is a tool or a benchmark that is used to track the performance of something broad in the market. Now, I say something broad because an index such as the ASX200 or the All Ords can be seen as something that generally tracks the performance of the entire stock market in Australia. However, you can get other indexes that track other things, such as a specific sector in Australia. In Australia, some examples are you can invest in specifically the financial sector, like all the banks and insurers and that, or you can invest in commercial real estate, so all the big real estate investment trusts all come together in an index. Also, you can invest in the resources sector, so an index made up of all the different mining companies in Australia. Further to this, there are global indexes such as the S&P 500, which measures the 500 biggest companies in America, or the NASDAQ, which is another American index. There's NASDAQs all over the world, actually. You have the FTSE in the UK, you've got the Nikkei in Japan, and these are tools which I'm pretty sure you can invest in some form in Australia as well through the ASX. These indexes vary in terms of what they aim to track, and some of them are indexes that have literally just been put together by investment firms, so they kind of create their own indexes in some instances. The example I referred to in my previous video is the ASX200. This is widely accepted as the best indicator for the performance of the Australian Stock Exchange. The ASX200 measures the performance of the 200 largest companies on the ASX. It weights the 200 companies by market capitalisation in the index. This means that the larger companies have a larger representation in the index. Weighting by market capitalisation, or market cap, is done to reflect the sheer size of the company and its impact on the Australian economy. For example, the largest stock currently in the ASX200 Index is the Commonwealth Bank, which has a market capitalisation of about $147 billion, while the smallest component of the index is aged care provider Estia Health Limited, which has a market cap of about $666 million. Just to further illustrate this point, if Estia Health went bankrupt, you probably would hear the occasional story about it, but not too much. But if the Commonwealth Bank were to go bankrupt, there would be a far gloomier feel amongst the Australian population. Index funds are a low-cost way that you can buy a small piece of a large number of companies, and because they generally aim to follow an index, as the name suggests, the investment costs associated with running the fund are comparatively quite low, particularly when you compare it to the fees and expenses associated with running an actively managed fund, and these savings are passed on to the investors. Put another way, to run an index fund is kind of like copying off the smart person next to you during your exam. You don't have to think too much about what you are doing, and you know you will still get decent results, at least in terms of following a whole market benchmark. I've seen index funds that cost as little as 0.05% to run, while I've also seen actively managed funds that average costs of about 2 to 3% to run, which, over the long term, that really eats away at the investor's returns. If you decide to invest in index funds, I strongly recommend looking at the product disclosure statement for the particular fund you wish to invest in. Particularly pay attention to the approximate costs associated with running the fund, as well as the investment strategy that is utilised, because like I said before, many fund providers will make alterations to their products as a means of differentiating themselves from rival funds. This means you may be buying something that isn't tracking what you thought it was, so it's important to do your homework. An index fund typically comes in two forms. The most common is what is called an exchange-traded fund, or ETF for short, which means to invest in it, you buy and you sell it on the stock exchange, just like any other share. The other form an index fund can take is that of a private or unlisted mutual fund, which is traded outside of the stock exchange. Many providers of index funds provide both options, and often I've found that most of them will offer more unlisted funds than listed funds. The upside of unlisted funds is that often you can buy into them with lower brokerage costs. However, one downside is that there's often like a minimum investment with an unlisted fund. I've seen like on the Vanguard website, many of them have like a $5, $10, or even $50,000 minimum investment. Whereas if you're buying an exchange-traded fund, you only really have to buy technically one share, although that can vary depending on the brokerage service you're using to buy. In the video description, I've given a link to the Market Index website ETF directory. Market Index is one of my favorite sites for obtaining information about ASX listed companies and ASX listed index funds. The index fund page lists many of the index funds available on the ASX and some basic information about the funds, which makes it a simple comparative tool and a good starting point for finding out more about particular index funds. The site can also, like I mentioned before, give you fairly thorough information on many stocks on the ASX for free. And you know what they say? The best things in life are free. Anyway, I don't want to overburden you with too much more information in this video, so I will try to do a follow-up video giving you some more specific information about Australian index funds soon. So anyway, until next time, thanks for watching. Remember to like the video and to subscribe to the channel if you haven't done so already. These are two other great free things you can do. Also, please feel free to leave a comment and discuss your thoughts on trading index funds. Take care, everyone, and I'll see you next time. Bye.